In the US, an average worker needs around 15 years of total income to buy a median home. In London, it takes over 20 years, even as tens of thousands of apartments sit empty. Sydney and Toronto fall in the 18 to 22-year range. In Seoul, mortgages now stretch close to a full working lifetime. Homes are being built everywhere. So why does owning one keep moving further out of reach? They both work full-time. One in healthcare, one in logistics. Their combined income sits close to the national median. No luxury debt, no risky investments. They start visiting open houses on weekends. Each month, the asking price resets higher. In the US, the median home price crossed $420,000, while the average 30-year mortgage rate jumped from under 3% to over 7% in less than 3 years. The house doesn't change. The monthly payment jumps by $800 to $1,200. In London, first-time buyers now average their mid-30s, often with parental support. Without it, the typical buyer needs over 20 years of income just to match the price of a median home. At the same time, the city holds tens of thousands of long-term vacant apartments, many owned through investment vehicles rather than residents. In Toronto, bidding wars regularly push final prices 10 to 20% above listing, even after interest rates rose. A household earning the median income now qualifies for a mortgage far below the median home price. The gap is structural, not personal. In Sydney, more than one-third of young households spend over 40% of their income on housing. Home prices sit near 9 times annual earnings, a level once associated only with speculative bubbles, now treated as normal. In Seoul, some lenders offer mortgages stretching 40 to 50 years, not to make homes cheaper, but to make monthly payments survivable. Ownership arrives late. Debt arrives immediately. They run the numbers again. Cut spending. Delay children. Move farther out. The math still doesn't close. Each year they wait, prices rise faster than wages. New buildings go up around them, cranes lighting the skyline at night. Yet many of those units are sold before completion, often to buyers who won't live there. For them, housing isn't shelter. It's a balance sheet. This isn't about discipline, or budgeting, or working harder. It's about entering a market where stability no longer buys access, and waiting only makes the gap wider. Across the world, housing affordability didn't collapse in one place first. It moved almost everywhere at the same time. Since the early 2000s, home prices in advanced economies have risen 2 to 3 times faster than wages. In the United States, real home prices increased by more than 120% since 2000, while median household income rose roughly half that pace. In the United Kingdom, prices nearly tripled over the same period, even as real wages barely moved for more than a decade. Canada and Australia followed a similar curve, with price-to-income ratios climbing into territory once considered extreme. What makes this pattern harder to dismiss is that it shows up across different political systems, currencies, and housing policies. This is not a local failure. It is a global structure repeating itself. Construction did not slow down. In many regions, it accelerated. The United States builds more than 1 million housing units a year. London continues approving tens of thousands of new flats annually. Toronto and Sydney have expanded vertically and outward for years. Yet affordability kept deteriorating. Not because homes stopped being built, but because the homes being built increasingly bypassed the people meant to live in them. Price-to-income ratios tell the story clearly. Historically, a ratio of 3 to 4 times annual income was considered manageable. Today, many global cities sit far above that line. London, Sydney, Toronto, Vancouver, and parts of California routinely exceed 8 to 10 times income. In Seoul, the ratio climbed so high that monthly payments became impossible under traditional loan structures. The response was not lower prices, but longer debt. Mortgage terms stretched to match prices. 30-year loans became standard. Then 40. In South Korea, 50-year mortgages entered the market, not to make homes cheaper, but to make monthly payments survivable. Ownership moved later into life. Debt arrived earlier. At the same time, investor participation surged. In the U.S., institutional investors accounted for roughly 20 to 30% of home purchases in some metropolitan areas during peak years. These buyers were not families moving in. They were funds allocating capital. In parts of Europe, entire residential developments were sold in bulk before construction finished. The buyer was not a household. It was a balance sheet. Vacancy exposes the contradiction. London reports tens of thousands of long-term empty homes while facing chronic housing shortages. Vancouver and Toronto show similar patterns. Paris and New York carry large stocks of underused or vacant units alongside rising rents. These homes are not missing. They are waiting for appreciation. In a system where prices rise reliably, occupancy becomes optional. Credit adapted to keep the system moving. When interest rates fell, prices rose faster. When rates climbed, monthly payments exploded. Either way, access narrowed. Lower rates did not make housing affordable. They made assets more expensive. Higher rates did not correct prices quickly enough. They filtered buyers out. What looks like a supply problem on the street is often an allocation problem on paper. Homes exist. Capital reaches them first. By the time wages catch up, prices have already moved. This pattern now appears across continents. North America, Europe, East Asia, and Australia all display the same sequence. Rising asset prices, slower income growth, expanding credit, longer debt, later ownership, more vacancy, more institutional control. At scale, housing stopped behaving like shelter and started behaving like infrastructure for capital storage. The system rewards holding, not living. Building continues. Access shrinks. And the gap between people who need housing and those who control it widens without dramatic headlines, year after year. At the center of the housing crisis sits a contradiction most people were never taught to question. When money becomes cheaper, homes do not become more affordable. They become more expensive. And the reason is not greed alone. It is mechanics. When interest rates fall, monthly payments shrink. A house priced at $400,000 suddenly feels reachable because the payment looks manageable. Buyers do not think in prices. They think in payments. Banks know this. Sellers know this. So when borrowing becomes cheaper, prices move up to absorb the benefit. The payment stays just within reach. The price runs ahead. This pattern has repeated across decades and across borders. In the United States, the long period of low interest rates after the early 2000s coincided with one of the fastest housing price expansions in history. After the global financial crisis, rates were pushed even lower to stabilize the economy. Mortgage costs fell. Prices surged again. The benefit never stayed with the buyer. It flowed into asset values. In the United Kingdom, ultra-low rates following the 2008 crisis did not restore affordability. They pushed prices in London far beyond wage growth. Even as income stagnated, borrowing capacity expanded. Homes became bidding contests, not shelter. Buyers competed on leverage, not savings. Canada followed the same path. Rates stayed low for years. Prices accelerated faster than population growth and construction. When rates finally rose, prices did not collapse evenly. Monthly payments spiked instead. The market filtered buyers out rather than resetting values. Australia saw a similar cycle. Cheap credit lifted prices faster than incomes, particularly in Sydney and Melbourne. By the time rates increased, prices had already embedded a decade of easy money. Affordability did not return. It hardened. The same mechanics appear in East Asia. In South Korea, rising prices collided with strict lending limits. Rather than letting prices fall, lenders extended loan durations. 40-year mortgages became normal. Then 50. The payment was stretched across time to preserve the price. Debt lengthened. Ownership delayed. This is the first layer of the paradox. Lower rates do not lower prices. They raise the ceiling of what buyers can bid. Housing responds not like food or clothing, but like a financial asset. Its price is anchored to credit, not cost. The second layer is scarcity that is not physical. In most major cities, land exists. Materials exist. Labor exists. What becomes scarce is access to leverage. Those who can borrow cheaply or deploy capital early win. Those who rely on wages fall behind. This is where capital enters quietly. When rates drop, institutional investors gain an advantage. They borrow at lower costs than households. They buy in bulk. They hold longer. Housing becomes a place to store value, not to live. In this environment, vacancy is not failure. It is strategy. In cities like London, Vancouver, and New York, empty homes coexist with housing shortages. These units are not waiting for tenants. They are waiting for appreciation. As long as prices rise, occupancy is optional. The third layer of the paradox is policy intent versus outcome. Governments lower rates to stimulate growth, protect jobs, and stabilize markets. Housing absorbs the stimulus first. Prices inflate. Wealth accumulates with owners. Renters fall further behind. The policy does what it is designed to do. The side effect is treated as a mystery. Once prices rise, they become politically difficult to reverse. Homeowners vote. Falling prices threaten household balance sheets. Banks carry mortgage exposure. Pension funds hold real estate. A correction becomes systemic risk. So the system chooses slow erosion over sharp reset. The result is a market that no longer clears on price. It clears on time. Buyers wait longer, borrow longer, delay life decisions, move farther away. The system does not break. It stretches. What looks irrational from the outside is internally consistent. Cheap money raises asset prices. Higher prices justify longer debt. Longer debt preserves prices. And the cycle repeats. Housing did not become unaffordable because society forgot how to build. It became unaffordable because it learned how to financialize shelter without breaking the system. This is the core contradiction. The tools meant to make housing accessible ended up making it scarce. Not in bricks, in reach. The housing market looks chaotic from the outside. Prices jump. Rates change. Buyers disappear. But underneath, the system runs with quiet consistency. Every major player knows their role. Every incentive points in the same direction. It starts with credit. Banks do not price homes. They price loans. When a household applies for a mortgage, the question is never what the home is worth in real terms. The question is how much debt can be carried safely on paper. Income, interest rates, and loan duration decide access. Price adjusts to fill the maximum loan allowed. When rates fall, borrowing power expands. Banks compete by offering larger loans over longer terms. Monthly payments stay just within reach. Prices move up to capture the difference. When rates rise, banks tighten approvals. Payments spike. Fewer buyers qualify. Prices soften slowly, if at all. The system prefers exclusion over correction. Next comes securitization. Mortgages rarely stay on bank balance sheets. They are bundled, sold, insured, and distributed across the financial system. Risk is diluted. Exposure spreads. Housing debt becomes an asset class. Once this happens, stability matters more than affordability. A sharp drop in prices threatens portfolios far beyond homeowners. Policy reinforces the structure. Governments support homeownership publicly while protecting asset values quietly. Tax advantages reward owners. Capital gains exemptions encourage holding. Zoning restrictions limit supply where demand is strongest. Each rule looks reasonable alone. Together, they lock prices in place. Then there are institutional buyers. Pension funds, private equity firms, and real estate trusts operate with cheaper capital and longer time horizons than households. They do not need mortgages approved one by one. They buy in volume. Entire buildings. Entire neighborhoods. Their returns rely on appreciation and rent, not occupancy alone. In many cities, new developments are pre-sold before construction finishes. Not to residents, to funds. Units change hands on spreadsheets before anyone sees a key. By the time a building opens, much of it is already spoken for by capital that has no intention of moving in. Vacancy is not an accident. In rising markets, empty units preserve flexibility. They avoid wear. They simplify resale. They wait. The faster prices rise, the lower the pressure to fill them. Housing behaves less like shelter and more like gold with walls. Local governments depend on this system. Property taxes fund cities. Rising assessments boost budgets. Construction activity signals growth. Political risk rises when prices fall. Stability becomes the priority, even if access erodes quietly. Households enter at the end of the chain. They compete against leveraged capital with savings and wages. They borrow at higher rates. They absorb risk directly. When prices rise, they stretch. When prices fall, they are exposed. The system does not need them to win. It needs them to keep paying. None of this requires conspiracy. It requires alignment. Banks seek safe returns. Investors seek yield. Governments seek stability. Each actor follows rational incentives. Together, they produce a market where homes are plentiful but access is rationed by capital strength. What appears as dysfunction is actually balance. Prices remain high. Debt expands. Ownership shifts upward. The system stays intact. Housing did not drift away from its purpose by accident. It was redesigned step by step to serve as financial infrastructure, a place to park capital, a mechanism to transmit policy, a buffer for economic shocks. People still live inside it, but they are no longer the primary customer. The same system produces different damage depending on where it lands. Housing financialization does not collapse cities the same way everywhere. It adapts. The outcomes look local. The cause is shared. In North America, the damage shows up as quiet exclusion. In many U.S. metropolitan areas, entire neighborhoods have shifted ownership without changing population. Homes are bought, held, rented, refinanced, and traded. Families move farther out. Commutes lengthen. Rents rise faster than wages. Homeownership rates among younger households fall year after year. Cities sprawl while cores hollow. Housing exists. Access migrates outward. Canada follows a sharper version of the same path. In cities like Toronto and Vancouver, prices disconnected from local incomes long ago. The result is not abandonment but compression. Smaller units, shared living, delayed family formation. A generation locked into renting not by choice, but by timing. Immigration fuels demand. Construction keeps pace. Prices still run ahead. The market does not clear. It filters. In Western Europe, the damage takes a different form. Historic cities absorb capital but shed residents. In London, Paris, and parts of Southern Europe, central neighborhoods fill with investment properties and short-term rentals. Long-term residents move out. Local services thin. Cities remain busy but less lived in. Housing stock turns over constantly, while communities fade slowly. Southern Europe shows another variation. In cities with slower wage growth, ownership remains culturally prized but financially fragile. Families stretch debt across generations. Young adults stay longer in parental homes. Mobility slows. Housing becomes both asset and anchor, tying people to place while limiting options. In East Asia, the consequences are more compressed and more intense. In South Korea, housing prices surged faster than incomes in dense urban cores. Government attempts to cap speculation tightened lending. Prices did not fall evenly. Debt adapted. Mortgages stretched longer. Ownership arrived later. Birth rates collapsed. Household formation delayed. Housing pressure bled directly into demographics. Japan presents a partial exception that proves the rule. After its asset bubble burst decades ago, prices stagnated. But the social cost was already absorbed. Aging populations, shrinking cities, and excess housing stock followed. The system corrected through demographic decline rather than affordability. Homes became cheaper. Demand vanished. In Australia, the damage appears as distance. Cities spread. Infrastructure strains. Young households move farther from employment centers. Time replaces money as the cost of housing. Commutes lengthen. Work-life balance erodes. Prices remain elevated. The system holds. In emerging economies, the effects are harsher and less visible globally. Rapid urbanization collides with speculative land markets. Informal settlements expand alongside luxury developments. Capital concentrates upward. Services lag. Housing becomes a source of instability rather than security. In some cities, Entire districts are built for investment demand while local populations are pushed into peripheral zones without infrastructure. Across regions, vacancy takes different shapes. In wealthy cities, empty units sit dark as assets appreciate. In developing cities, incomplete projects stall as capital moves on. Both represent the same logic. Housing responds to capital flows, not human need. Environmental costs follow. Sprawl increases emissions. Infrastructure expands inefficiently. Materials are consumed to build homes that sit underused. Land is locked into low-density investment patterns. The physical footprint grows while social capacity shrinks. Social costs accumulate quietly. Delayed home ownership correlates with delayed family formation. Long-term renting increases insecurity. Wealth gaps widen between owners and non-owners. Housing ceases to function as a stabilizing force and becomes a sorting mechanism. None of this triggers immediate crisis. That is the system's strength. It degrades slowly. Each city absorbs damage differently. Each household adjusts individually. There is no single collapse, just persistent pressure. From the outside, these outcomes look unrelated. Long commutes in Australia, empty flats in Europe, lifetime debt in East Asia, exclusion in North America, informality in developing cities. But the structure underneath remains consistent. Capital flows toward housing. Prices rise. Access narrows. Debt stretches. Communities adapt downward. This is the map. Not of one city, not of one country, but of a global system expressing itself locally. Different symptoms. Same engine. They bought at the edge of what the bank would allow. Not because they wanted risk, because waiting meant falling further behind. The approval came through weeks before rates moved again. The numbers worked on paper. Barely. The house was smaller than planned. Farther from work. New build. Thin walls. High price. The payment absorbed more than a third of their income from day one. They told themselves it was temporary. Wages would rise. Inflation would ease. The market would calm. Then rates climbed. In the United States, households that bought during the low-rate window between 2020 and 2021 faced a sharp reset. When mortgage rates moved from under 3% to above 7%, the monthly cost of the same home jumped by hundreds, sometimes over $1,000. The property did not change. The debt did. Refinancing became impossible. Renewal became punishment. Missed payments did not arrive as a single event. They accumulated quietly. First the emergency fund, then the savings account, then the credit card. The household stayed current until it couldn't. In Canada, the shock followed a different path. Variable rate mortgages were marketed as flexibility. When rates rose, payments stayed flat, but principal stopped shrinking. Borrowers paid month after month without reducing what they owed. Ownership existed on statements. Progress disappeared. Some households reached trigger rates where payments no longer covered interest. The mortgage expanded instead of contracted. In the United Kingdom, the reset came through fixed-term expirations. Millions of households rolled off low-rate deals into a higher-rate environment within the same year. Monthly payments surged. Renters felt it indirectly as landlords passed increases through. Owners felt it directly as cash flow tightened. The adjustment cut across tenure. In Europe, housing stress collided with energy costs. Heating bills rose sharply. Food prices followed. Renters absorbed increases without the insulation of long contracts. Owners absorbed rate hikes without the flexibility to move. The home stayed fixed. Everything else adjusted downward. In Australia, distance magnified the damage. Households who bought on the fringe faced rising transport costs alongside higher mortgage payments. Commutes stretched longer. Fuel prices climbed. Time became expense. Fatigue followed. The house anchored them in place as costs rose around it. In East Asia, the pressure compressed into time. In South Korea, extended mortgage terms delayed freedom. Debt followed households into midlife. Home ownership arrived late. Childbearing arrived later. Birth rates fell to historic lows. Housing did not just shape finances. It reshaped demographics. The tipping point rarely came from the market itself. It came from life. A job transition that took longer than expected. An illness. A separation. A business slowdown. The system assumes continuity. Paychecks arrive. Rates adjust slowly. Employment holds. When reality broke that assumption, margins vanished. Defaults did not arrive as spectacle. They arrived as notices. Deadlines. Phone calls. In some cities, properties returned to lenders who already held thousands like them. The transfer back into the system happened quietly. The loss was asymmetric. Capital absorbed volatility. Households absorbed consequence. When prices rose, gains accumulated upward. When payments failed, individuals fell out one by one. The market did not collapse. It filtered. There was no villain in the room. The bank followed underwriting rules. The lender followed regulation. The investor followed yield. The household followed math that once worked. Each decision was rational in isolation. Together they produced fragility. Housing promised stability through ownership. Risk arrived anyway, not as sudden collapse, but as sustained pressure. People adjusted by cutting elsewhere. Healthcare, food quality, retirement savings. The home stayed. Life narrowed. Foreclosure statistics lag reality. By the time numbers move, damage has already spread. Stress accumulates before it registers. Loss becomes private long before it becomes visible. For every household that fell out, many more hovered at the edge. Not defaulting, not safe, adjusting downward, waiting for relief that did not arrive. The system continued to function. Prices stabilized. Construction resumed. Transactions slowed, then recovered. The cost had already been paid. Housing did not fail loudly. It failed individually. In kitchens late at night. In spreadsheets revised again and again. In plans quietly abandoned. This was the peak of the contradiction. Ownership did not deliver security. It transferred risk onto those least able to absorb it. The structure held. The people inside adjusted. The collapse does not look like a crash. It looks like drift. Home prices stop rising fast. Sometimes they flatten. Occasionally they dip. Headlines declare relief. But underneath, the structure has already shifted. The damage does not reverse. It settles. Ownership arrives later, or not at all. Across advanced economies, the age of first-time buyers has climbed steadily. In the United States, it moved into the mid-30s. In the United Kingdom, it pushed closer to 40 in some regions. In Canada and Australia, first ownership now often requires family assistance. Wealth transfers replace wages as the entry ticket. This delay reshapes life decisions. Household formation slows. Marriage rates soften. Birth rates fall. In countries like South Korea, Italy, and Japan, housing pressure correlates closely with demographic decline. People do not opt out of families because preferences changed. They opt out because stability arrives too late. Cities hollow differently than before. Not through abandonment, but through substitution. Long-term residents are replaced by short-term tenants. Communities turn over faster. Schools shrink. Local services lose continuity. Neighborhoods remain expensive and busy, but less rooted. Housing stock stays full on paper while social fabric thins. Rental markets absorb the pressure next. As ownership moves out of reach, demand concentrates on renting. Rents rise faster than wages. In many cities, rent growth outpaced income growth for most of the last decade. The burden shifts from debt to cash flow. The result is constant vulnerability rather than long-term risk. Inequality hardens into structure. Owners accumulate equity as prices rise. Renters pay into the system without capture. The gap compounds. Housing becomes a primary driver of wealth inequality across generations. Not because owners are more productive, but because they entered earlier. Labor mobility weakens. High housing costs anchor workers in place. People stay in jobs they would otherwise leave. Commutes lengthen. Productivity suffers quietly. In cities with extreme housing pressure, employers struggle to attract essential workers. Teachers, nurses, service staff travel farther or leave entirely. The city functions, but less efficiently. Public finances bend around property values. Municipal budgets depend on assessments. Falling prices threaten revenue. Rising prices strain residents. Policy choices narrow. Governments manage housing as a stability problem, not an access problem. Interventions soften volatility rather than reset affordability. Debt persists longer. Mortgage terms stretch across careers. Retirement intersects with repayment. In some systems, households carry housing debt into old age. Asset ownership rises. Liquidity does not. The home becomes wealth on paper and obligation in practice. Environmental costs accumulate alongside social ones. Urban sprawl expands as people chase affordability outward. Infrastructure stretches thin. Transport emissions rise. Land is consumed inefficiently. Homes are built farther from work, schools, and services. The carbon footprint grows while density remains misallocated. In emerging economies, the collapse looks sharper. Informal housing expands. Speculative development outpaces infrastructure. Land prices rise faster than wages. Informality absorbs the excluded. Housing insecurity becomes normalized. The system scales, but unevenly. Political tension follows quietly. Housing ceases to unify interests. Owners resist change. Renters demand relief. Younger voters disengage or radicalize. Policy becomes fragmented. Long-term solutions stall. The system persists because too many balance sheets depend on it not breaking. What makes this collapse durable is its invisibility. There is no single moment of failure. No sudden implosion. Each adjustment appears rational. Each household adapts privately. The aggregate effect emerges slowly. Markets stabilize without healing. Prices stop rising rapidly. Access does not return. The window does not reopen. It moves further away for the next cohort. Housing once anchored societies. It provided security, predictability, and place. As it financialized, it absorbed shocks meant for the economy at large. The price of stability shifted onto individuals. This is the aftermath. Not rubble. Not panic. Just a new normal where shelter is plentiful, but ownership is conditional. Where cities function, but exclude. Where growth continues, but belonging thins. The system did not collapse outward. It collapsed inward, into delayed lives, narrowed options, quiet resignation. The structures remain standing. The consequences settle in. At night, the cranes keep moving. Lights hang above unfinished towers. Glass reflects a city that looks alive and expanding. New units are announced. New projects approved. On paper, housing never stops growing. From a distance, it looks like progress. Prices no longer surge the way they once did. Headlines speak of cooling markets, of balance returning, of stability. But stability for whom is left unclear. The same buildings stand. The same units trade hands. Ownership remains concentrated. Entry remains delayed. The system adjusts just enough to avoid breaking. It does not reset. What changed is not the skyline. It is timing. People arrive later into ownership, or not at all. Lives are organized around housing rather than the other way around. Decisions are postponed. Distances lengthen. Risk is absorbed quietly. The home still exists. It still shelters. But it also carries debt, expectation, and exposure. It reflects policy choices, financial incentives, and capital flows far beyond the household living inside it. In this system, building more does not guarantee access. Lower rates do not guarantee affordability. Higher rates do not guarantee correction. Each lever moves something else instead. Housing has become infrastructure for stability. It absorbs surplus capital. It buffers economic shocks. It preserves balance sheets. And in doing so, it transfers uncertainty downward, one household at a time. There is no villain to point to. No single decision that broke the system. Only a series of choices that made sense locally and aligned globally. Each adjustment appeared reasonable. The outcome accumulated anyway. Cities continue to function. Markets continue to trade. Life continues inside the structures built for it. But the relationship between people and place has thinned. Shelter is plentiful. Security is conditional. The question is no longer whether housing will become affordable again. It is whether affordability was ever the goal once housing became a financial instrument. The cranes will keep moving. The lights will stay on. The system will remain intact. The cost will continue to be paid quietly, over time, by those who entered after the rules had already changed.